It has begun. I've been warning repeatedly that the bond market crisis and the skyrocketing yields in the bond market is going to lead to rising mortgage interest rates. Well, even though the central banks and the government have come to the aid of the stock market and the housing market, unfortunately, they're quickly running out of tools. And what I continue to say, and what you must know, the government and the central banks aren't really running the show, it's the markets that run the show. If all of a sudden people start selling off bonds and bond yields go up, mortgage rates are gonna have to follow. But if you're like, well, what's a bond, man? Well, bonds are pretty much just treasuries issued by the government, aka government debt. They'll issue debt and then they'll say, hey, we'll pay you back 0.1% interest on this debt backed by us. And last year, yields plummeted to all-time lows, but now they have skyrocketed about 1%. So mortgage rates are starting to increase, and this is going to have a devastating effect on the housing market and the stock market. But what you have to understand, this is not just happening in Australia, the US, this is happening globally, because now all the markets have been globalized, and what can happen in one market, or when one market goes down, it can affect the other global market. So in this video, I'm going to go over how these rising interest rates are going to affect the markets, and I'm also going to go over why you need to know this core information, what's going to happen to interest rates in the future, and what we can do to prepare. So the first major bank to lift its interest rate is Commonwealth Bank. It has lifted its 2-year fixed rate from 1.99% to 2.19%. And I know what you're thinking, this is just a 0.2% increase. It's not going to have a huge effect on the market, and this rate increase won't, but there's going to be more rate increases coming. And nobody wants to be first and nobody wants to be last. Commonwealth Bank was the first to hike interest rates, and you bet the other major banks are now going to follow. This also goes along with, in the US, interest rates have been rising for 5 consecutive weeks. And you all have to follow, wherever you are in the world, the US market, because the US market is the biggest economy in the world, and they own what normally moves first, and what happens to America will affect us everywhere. The 30-year fixed rate mortgage in the US rose again by 4 basis points to 3.09%, but it is 56 basis points higher than the year prior. And like I say, for every 1% increase in interest rates, the housing market can drop 10 to 15%, and also the stock market can fall 5 to 10%. Like what we saw a couple of weeks ago, the Nasdaq dropped almost 10% once the bond yields started surging. So whether it's the housing market or the stock market, you need to know this. And something that I've been pondering lately, and I'm sure you've all seen this last year and early this year, is the Great Reset. And something in the Great Reset, a quote says, "You'll own nothing and you'll be happy." And I'm sure you've seen this all over YouTube. But I've been thinking to myself, what does that really mean? Well, people aren't just going to give up their property. They're not just going to give their houses away. But what could happen, and what I think is happening, is last year, central banks, the Federal Reserve and the Reserve Bank of Australia, New Zealand Central Bank, Canada Central Bank, they all plummeted interest rates. They all said, come on in guys, take on as much debt as you want. You want a loan, you get a loan. And they're pretty much saying, look, it's free money, loans around 2%. Come on, take on as much debt as you can. Inflation will do the rest. But people are like, but man, what if interest rate rises? Interest rate rising? That's not gonna happen. We'll keep our interest rates low for 4 years, guaranteed. The bond market just entered the chat. That's right. Well, the bond markets and people that bet that interest rates are going to rise, because there are markets where you can bet on when the central banks will lift interest rates, they're all betting that interest rates are going to rise much sooner than the central banks say in 2024. They're all betting that there's going to be rate hikes in 2022. And who knows, this is a rapidly changing environment and market, so we may even see interest rates rise even earlier. And even if the central banks don't go out there and raise interest rates, the commercial banks, they're seeing all this FOMO in the housing market, and they're like, ooh, so much FOMO. They're willing to pay $100,000, $500,000 over reserve. I'm sure they're willing to pay 0.5% more in interest just to get into the housing market, because hey, it's gonna make us all rich. So even if the central banks don't lift interest rates, the commercial banks are now starting to lift interest rates to make profit, because again, they're businesses, they need to make profits, and they're taking advantage of this huge amounts of FOMO in the housing market right now. Bankwest Curtin economist has suggested that the RBA may be forced to lift interest rates in mid-2022. This could be as early as the second half of 2022 if the labour market continues to respond and prices continue to push upwards, particularly through the housing market, she said. Another thing that's really grinding my gears, and I'm sure everyone knows it, everyone's saying it, that inflation is much higher than they're reporting. There's something called the Consumer Price Index, or the consumer goods, and they can just take a basket of goods. Say you go to the grocery store, you fill up your shopping trolley, you buy some electronics, you buy some food, you buy this, you buy that, some things you have to survive, some things you don't have to survive, and they just put these prices and they bundle them all up and they say, okay, on average, all these costs went up 1%, blah, blah, blah. But the thing that's happening is the things that you need mandatory to survive, like housing, electricity, water, food, they're all going up much, much higher than inflation. And central banks are now admitting, hey, look, you know what actually be a really cool thing? Let's let inflation run hot. Let's inflate away this debt. But don't worry, it's just going to be temporary just this year and then it's going to fall down. Everything will be okay. But the markets don't believe that. And I know all you don't believe that. Inflation is going to be much higher than expected. And hey, I'm sure even they can come out and manipulate the numbers and say, nah, it's only 2%, we're not going to lift interest rates. But the markets believe inflation is going to come and they are going to have to lift interest rates to get everything under control. And another new development that's happening right now is the RBA's tip to put the brakes on house prices in 2021. RBC Capital chief economist said annualized nationwide house price growth topped 20% in February, with the Reserve Bank Governor Lowe already laying the groundwork macro-prudential policy to rein in runaway house prices. And what you all need to know is the housing market isn't a free market. It's 100% manipulated. Like what happened last year when there was fear of a big market crash, the RBA stepped in, lower interest rates, they started term funding facilities to offer cheap credit to banks at 0.1% so then they could drop mortgage rates to stop a housing market crash. But the opposite can happen. Now that prices are running away and if they kept this rate of growth up for the next year, that house prices will go up 20%. This is creating a big political issue and a moral hazard. So central banks could step in like what they did in 2014 and 2017, where they limited the amount of credit to investors and they also limited the amount of interest-only loans. Unfortunately, what is happening right now is people are leveraging to the T. They're leveraging to the max. In the stock market, margin debt is at all-time highs. In the housing market, new loans with debt-to-income ratio greater than 6 times are up 80%. And just before every market crash is euphoria. And right now we're in the euphoric phase of the housing market and the stock market, where it just seems like stocks only go up and house prices only go up. And even if there's a little hint of a housing market crash, the good old government will come in there to save us. While making financial decisions, betting that the government will come to your aid and save you is a terrible financial decision. So what's the policies on the table where the RBA could clamp down house prices? What they could do is they could clamp down on high LVR loans. In Australia, you can still get investment loans of 90%. So they could easily change that to 70 to 60% like what New Zealand did. But what could be a disaster is these first home buyers taking up this 5% deposit scheme. And then if interest rates rise 1%, like I said, and house prices fall 10%, they're going to be underwater. They could also increase the interest rate buffer for borrowers. What happens when you used to apply for a loan, the bank would assess you at being able to repay at an 8% or, for example, a 6.5% interest rate. But then that was scrapped when the house prices started to fall because we can't have a housing market crash. So they just said 2.5% above whatever the current interest rate is. So that would be around 4.5% to 5%. But if they reinstate that up to 8%, all of a sudden people's borrowing capacity is going to be slashed by 20%. And this is going to have a huge effect on house prices because it's credit growth that fuels house prices, not just location and immigration. But hey, we don't have immigration either right now. And they could also have greater scrutiny on borrowers' income and expenditures. So to put this simple, what this means for you, we have rising interest rates. We've had ultra low stock, but more stock is coming on the market, especially with this house building frenzy across the world. Lots of people are building houses in Australia and the US. So this is adding more supply when there's no international migration. We're going to see central banks or commercial banks start tightening lending standards, meaning people's borrowing capacity is going to be reduced from high interest rates and tighter lending restrictions. So the stock market is what this means is if interest rates continue to rise, especially the high growth stocks sector and the tech sector, which has been running hot and relies completely on low interest rates because if you can get margin at 2%, then people are going to go speculate on things like Tesla, Google, and Afterpay. And also it's now 1 year since the stock market hit its all-time low. So people that brought the bottom and got stocks at these ultra low levels, they can now sell and get a 50% discount on capital gains tax. Because what happens with the housing market and the stock market is if you hold for longer than a year, you get a big discount on capital gains tax. And again, going back to that great reset and the quote of "you own nothing and be happy," what they have done is they've lured people in with ultra low credit. People have borrowed up to the T, but leverage markets are very unsustainable markets. And in what happens in the stock market and what happens in the crypto market is big hedge funds, they look for when markets are leveraged to the max, because when they sell, that automatically triggers margin calls for stocks, so stocks plummet even faster. And what could happen in the housing market is people fall into negative equity, or maybe some people brought in some risky areas, like what happened with Westpac in 2017. They called up some of their investors and said, "Hey, you're in a risky area. You've got 28 days to find a new lender or sell your property." So again, people aren't just going to give up their homes, but if interest rates skyrocket and there's mass defaults, the governments and the banks can just clean up and take all those assets. But hey, will that happen? Who knows? Bonus tip. Also, what's happening right now in the housing market is people aren't paying market value for properties. I'm sure you've all seen properties going for $500K, $1 million over reserve, putting down offers at $200,000 above the asking price. Well, that's not really market value. That's just people FOMOing in. So then when there is a correction and they've brought house prices 20% above market value, they're just going to enter negative equity even quicker. So guys, I urge you, don't FOMO in these markets right now. Make sure you make good financial decisions. This doesn't mean it's going to crash tomorrow. This is a developing story. This is a developing thing that's happening in the market, but you all need to be aware so you can be well informed and make the best decision. And for all my loyal viewers and subscribers still watching, you're awesome. And if you haven't already, please tap that like and subscribe button. I'll keep you all updated in the latest that's happening in the housing market, the stock market, and global finance news. I'll pop up some of my other videos now. I'll see you there.